Did you know Canada represents just around 3% of the world's capital markets? If you invest only in Canadian companies, you're missing out on 97% of the global market. Hi, Dan Frost with Raymond James here to talk to you about these newer equities called Canadian Depository Receipts, or CDRs for short. CIBC created this product for us here in Canada so we can have investments in some of the world's largest companies without paying huge foreign exchange fees to buy and sell. This is a relatively new product that started in July of 2021, and the results so far look fantastic. Some reasons why you may want to use a CDR is that you'll have exposure to US stocks in Canadian dollars. With this, you'll get the protection from currency fluctuations from an embedded hedge in each CDR. You can buy and sell them like an ordinary ETF or a stock, but CDRs are a little more different. And CDRs are a little more affordable for investing into the world's largest companies. The reason for this is fractional ownership. This allows investors with smaller amounts of money to participate in the growth of a stock with fees that previously just weren't available. CDRs are even qualified investments for TFSAs, RSPs, RIFs, and RESPs. Basically, you buy the stock of a company you want. Let's say Walmart. Instead of converting your Canadian dollars to American dollars, you could just buy the CDR. Each CDR has a fraction of ownership of the underlying foreign stock, in this case, Walmart. If Walmart decides to pay out a dividend, you receive that dividend in Canadian dollars, which may then be subject to withholding taxes in the same manner if the underlying shares were held by you directly. Voting also works kind of the same way. As a CDR owner, you have to indicate to CIBC how you would vote through CIBC's voting portal. Then CIBC will do their very best to vote on the underlying shares in accordance. Now, for tax purposes, you have to talk to a tax professional. The expectation is that the Canadian tax penalties when owning a CDR is the same just as owning the underlying securities. Let's use $10,000 Canadian for example, which would only get you $7,400 US. Each time you convert from or to US dollars, it could cost you anywhere between 2 and 4% of your money as a conversion. This is known as the spread. Because the CDR has a currency hedge, your entire $10,000 is working for you, and it will go up or down following the underlying shares only. This actually reduces your risk from currency and allows you to focus on whether or not the company you bought is performing well. Now, this isn't specific investment advice either. It's meant to educate you on a new kind of equity that's in the markets to provide investing into foreign companies without the risk of exchange rates. Anyway, that's all for this week. Thank you for watching. If you want to learn more, call down and we'd be happy to explain. Our number's in the description below, or check out the bio of our Facebook page. Thanks for watching.